Welcome to Subramani. I'm going to talk about a very old topic, that is diversification or diversification as you wish to pronounce. I find two categories of people. One is not diversified at all. These are typically people holding a lot of ESOP shares. So 80% of their portfolio or 70% of their portfolio could be their own company in which they have made a job, career and investment. So that will be obviously the company has to be very good. It has to be HDFC Bank, HDFC Limited, Infosys, TCS kind of a thing, where there has been tremendous appreciation of the small amounts of ESOP also which they got, and then they got more and more ESOP as they grew. The other end is somebody with say 40-50 crores and diversified across all assets, real estate, REITs. Real estate also has residential real estate, commercial real estate. Then there is art fund, direct equity, direct government bonds, equity mutual fund, bond mutual fund, balance funds, commodity funds, right? So across everything. But then by the time you have this 50 crores, you are 60-65 years of age, maybe even 70 years of age. So you have built a very complicated portfolio. Now when you tell a person, if you tell me that my portfolio is complicated, I am bound to tell you no, it's not complicated because I have created it. But who is going to manage it? It is my wife who is going to manage it after me, or my daughter who is going to manage it after me. If my daughter or son are not interested in managing it and my wife can't manage it for whatever reason, she has not learned, it is important that when I hand over, or when I am forced to hand over, or when my wife takes over after my death, she should not get overwhelmed by the size of the portfolio, by the number of items which are there. Mostly you don't need too very complicated. I mean, even with 50 crore AUM of your own assets, you don't need maybe a PMS, you don't need an AIF, right? I can keep on adding things to your portfolio and say add this, add this, add this. You should have a multi-asset fund. So you have multi-asset fund, you have gold, you have silver fund, you have gold and silver fund. So the amount of money that you have invested in gold goes up dramatically, right? So diversification is simple, it's not very complicated, but it can be made complicated, but in a very simple way to start. Suppose you have shares of only one company, you have shares of say Apple. So it's risky, right? All your money is in one company called Apple. If something goes wrong with Apple, your money goes for a toss. Or all your money is was in a company called Satyam. Satyam went down and you got wiped out, right? These things can happen. Now you add Microsoft, Reliance, SoftBank to your portfolio of Apple. Then suddenly you realize, oh, now you have diversified well. You got something in India, you got something in Japan, you got something in US. So you're better diversified. You're diversified geographically and from an asset point of view. You have 2-3 assets. Another thing you can do is have a portfolio of say 60-70% in equity and 30% in bonds. Do a equity share portfolio. Does it give you a better return? Yes, it gives you a better return than a bond portfolio. However, the drawdown can be long, and when you need the money, maybe for 3 years, if the market doesn't move and you need money, you may have to do a distress sale. To avoid those things, to get peace of mind, saying whenever I need money, I'll withdraw from my bond fund. So you need some bonds. Bonds are not here to improve the return. They are here to give stability in case of something going wrong. It's not that can you put 100% in equity? Yes, you can. Will it give you better returns? Maybe it can. But it is not just about returns, it is to get those returns. How many sleepless nights did you spend, right? So suppose today you were invested in Taiwan, Korea and China, and realize that Korea has gone into military rule, Taiwan, there is risk of China anytime bombing it, and China's market is not doing well. What will you do? Right? So you need a well diversified portfolio. Now there are some people who swear by an index fund. That's fine. If you swear by an index fund, that's fine. But if you are going to invest only in India, you will have only an India index fund. However, if you believe in the index fund, you should believe in the international index fund, right? So the international index fund would have something like 65% in US. That's a fact. You cannot deny that. Whether US is doing well, not doing well, doesn't matter. Market cap is not going to disappear overnight. So you create a diversified portfolio, and that's it. Go ahead with life. So how do you create a diversified portfolio, right? So that is ideally you want to own assets which are uncorrelated performance, right? Like shares and bonds. You think when shares go up, bonds will go down, and that's a fair enough assumption that both may not go up and go down at the same time, but it could happen. Then you don't, if you have a portfolio of say 8 items and all are in the green, you're not diversified enough. You have to have 1 or 2 in the red, which means you know when the others go into the red, these could go into green. So that is how diversification is. So it should be diversified across, let's say if you're investing in India, you want geographic diversification. You want some companies based in Bombay, some in Chennai, some in Bangalore, some in Delhi, right? So you want a diversified portfolio from geography. You want across business houses. All your money can't be in Tata Group, all your money can't be in Murugappa Group, all your money can't be in Adani or Ambani. You will have a diversified portfolio across industrial houses. You will have it across industries, right? You will have something in the oil, something in software, something in hotels or airline, whatever. You will create a diversified portfolio, something like an index. So you will look at the index weight and say, okay, 11% has to be banking, 14% has to be technology or whatever. You will do it accordingly. Right now, I think 30% is BFSI. So you will say, oh, BFSI, but many BFSI are not represented in the index. The index does not have an insurance company. So maybe I should buy LIC, whatever. You do all that and diversify your portfolio. So I was just thinking, let me take the examples from some, of course it comes from risk tolerance and asset allocation also. Your asset allocation depends on your risk tolerance also. So if you're a 20-year-old whose father is a vice president in a bank and mother is a surgeon, and both of them are doing extremely well, obviously the ability to take risk is much higher, the need to take risk may be much lower, and you may not need life insurance at all because there's nobody dependent on you. Maybe you're not even planning to get married, or even if you do get married, you have enough assets. By the time you're 30, you'll have enough assets and don't need insurance. That is also possible. So it depends on your total amount of money you have, the amount of risk you need to take, the amount of risk that you have the ability to take. A combination of all this will decide your asset allocation. So what all does your asset, your risk tolerance depend on? It depends on your education and qualifications. If you're well qualified, chances are even if you were to lose your job, you will get another job. Chances are if you do a startup, you can still go back to your parents because they have enough money to support you through 1 or 2 failed startups, right? Also remember, the role of diversification is not to maximize returns. It is to maximize returns for the unit of risk that you take. You want good returns, you should be able to eat well and sleep well, right? All while doing all this, what is the return that you get? That is the question that diversification actually answers. If you are a young investor from a rich family, obviously your risk taking ability is higher. If you are a young investor but you are parents, siblings and maybe wife dependent on you, then your ability to take risk goes down. So ability to take risk, which means the ability to have a more diversified portfolio, comes from the fact that you have other sources of income and you are not dependent on the portfolio for your day-to-day income, and if nothing happens in the market for 10 years, it will still not change anything for you. You will have the ability to take that simply because you are able to sit tight because you have other sources of income. Also, diversification can happen across asset classes, which is what we spoke about, and intra-asset classes. Within equity, you could have large cap, mid cap, small cap. You could have US, Europe, Japan, China, Taiwan, South Korea, India, right? You could have diversified across geographies with the same asset class. You could have micro cap. You could be investing in startups. All these are forms of equity, right? So across asset classes, and within the sub asset classes also you can have diversification. All this leads to ask us a question, what are the assets that we can look for diversification. We'll do it in a separate video. Thank you.